Are you trading yet? It's time to get in the game.
How's it going, everybody? It's your boy Orlando, aka King Smitty, and I'm here today at First Coast Christian Ministries, and we're on our road to financial freedom. It's our second class. This is the month of February. We had one last month, and I do have a PowerPoint right above me, so the people in the audience can see. But I will see if I can edit it into this video for the YouTube channel. But just a little recap, or before we get started, Proverbs 13:11 says, "Dishonest money dwindles away, but whoever gathers money little by little makes it grow." And so that's what we're trying to do here in the stock market. We're trying to gather this money little by little in order to gain financial freedom. And I'm just trying to give a little financial literacy, just a little bit from what I know to others who might not know as much as I know, or who might know just as much as I do or more, and maybe we can give different perspectives and help each other grow on this road together. But of course, I am not a financial advisor, just an average day brother trying to help out my community. You feel me? But a little recap of the last class. First thing you want to do is budget. You want to track your expenses to your paycheck. You want to write everything down so you can see exactly where your money's going to, so that way you can budget your finances correctly. First and foremost, after you pay your tithes, is you do want to pay yourself. Consider yourself as a priority. So pay yourself. The next thing we had is emergency fund. You want to at least try to get at least 3 months worth of funds for your emergency fund, just in case anything happens. You're not trying to cover these emergencies with your investment money or even a credit card where you have to pay X amount of interest on an emergency. That's like adding salt to the wound. So you don't want to do that. Pay off your debt as quickly as you can. There's multiple methods. You have the Snowball Method, which is paying the lowest interest first, and then once you pay that off, you put that lump sum into your next lowest interest, and then you keep doing that until all your debt is paid off. You can do the avalanche method, is which you use the highest interest and you pay that off first. Then once you pay that off, all those funds from that old bill will just get transferred over to the next highest interest, and then you'll just continue that on as well until that is paid off. Or you have the debt consolidation, where you just consolidate all of your debt into like one card or one loan, so that way you don't have multiple payments coming out. You just do one payment a month. Try to save your money that way. But that's just a little recap. Last thing is multiple streams of income. It's going to be very hard to be financially free with just one job, especially if that job is taking up majority of your time and majority of your funds are going directly towards bills, not having money to save for an emergency fund, let alone invest. So multiple streams of income. You could sell stuff, make a profit. You can get into some stocks, get some dividend plays going, get you a monthly income or a quarterly income going on. Rental properties, get you some houses, get in the real estate market. And then you just have, like I said, what you earn from going to your normal job. So multiple streams of income is really going to help us on this road to financial freedom. Do you see a dollar saved is equal to $2 that is earned? And some of the top investments are the stock market, which gives you an average income return of 10%. Real estate, which historical return on interest is roughly 10.6% to 12%. And Roth IRAs, which return on investment is roughly around 7% to 10%. And then as well as you have your emergency funds, which is another top investment. So those would be the top investments. I've already spoke about the emergency funds. I'm giving you information about the stock market now. And hopefully for one of our future classes, if not next month, I know I did get a request for more talks about the stocks and a little bit more in detail about that. So if not next class, then the class after that, we will try to get a real estate agent, one of the top in Jacksonville, in my opinion, to come through and just shed a little light about the real estate investing and how to get started into that and whatnot. For the investments, like I said, the stock is the type of investment that represents an ownership share in a company. A company is issuing a stock just to raise money and to grow their investment and invest into their company. And for people like us normal day investors, we're using the stock market to grow our personal portfolio and our personal wealth and to outpace inflation. So if inflation's going like this, you kind of want your portfolio to be going a little bit higher than that. You don't want to be inflation going right here, then your normal job paycheck is right there, because now inflation is outpacing your normal job and your dollars aren't worth as much as they once were. For that stock market, the bulls versus the bears, you might hear that talk a lot. When somebody say they're bearish or it's like a bear market, that's meaning that the market is going down or the stock is going down and it's dropping, or they believe it is going to drop, so they're called bears. And for the bulls believe the market is going to go up, or the price of the stock is going to raise, or you might hear the term, I'm very bullish on this stock. That means they really believe that stock is going to continue to grow higher. So bulls make money, bears make money, pigs get slaughtered. Don't be a pig trying to hold too long. You lose money like that. Sheep, you're just watching, you're not getting into the game. So the next one, things to consider. And I have a few questions for you. First thing to consider is, what is your goal? So why are you trading? Are you trying to retire early? Are you trying to pay off your mortgage? Are you trying to get funds set aside for your kids' schooling or college in the future? What are you trading for, investing for? What is your purpose? You don't have to tell me. You can write it in the comments. Make sure you like and subscribe. Everybody out here, make sure you subscribe. King Smitty. 55 is my trading journey. And today we're just doing a road to financial literacy, financial freedom. But the next question is, who would be your broker? There's multiple brokers. You got TD Ameritrade, you got Charles Schwab, Robinhood, Webull, Interactive Brokers, and they all have they're all different. They're all the same but different. You get it? Same but different. You know. So which one would you choose? I personally am with TD Ameritrade. That's one of my favorites. I also have a Webull account. I know if you sign up with Webull, you do get some free stocks. So I will have my link into the video. So you can definitely just click up, sign up, get some free stocks. You deposit $100 in, you get an extra couple of free stocks. So definitely look into that. If you want some free stocks, it's free money just for signing up. So definitely look into that. Some more questions for me to ask is, will you monitor your own portfolio, or would you have a robo-advisor? So do you want to be hands-on, like looking at your portfolio? I want this stock, I'm going to go get this stock. Or do you just want to put $200 in a paycheck, $50 a paycheck, and say, hey, trade that for me? Me personally, I like to do it myself. I like to be in charge of my money. Like if I lose the money, I want to be responsible for losing the money. I don't want to give it to you and then or the robo advisor or another person and they lose my money and I'm looking like I trusted you. And I'd rather just learn myself and then be in charge of my own money. And it's been very good for me so far since I've done that. The next question is, will you be trading your own money or will you be borrowing money? So normally when you set up an account, it's going to ask you, is this a cash account or is it a margin account? Cash account is when you deposit money into this trading account, that's the funds you are able to trade with. A margin account is you're borrowing money from your broker, like I said, Charles Schwab, TD Ameritrade, whatever, and I'm sure you will have to pay that back with a little interest in it. And things like that is, I know with the GameStop and the AMC, they were selling people shares who were using marginal account because they're saying it's too volatile and they're trying to protect your money. They're really trying to protect their money because that stock was running up really high. So they were selling people stocks that were on marginal accounts. So that's why I like, hey, all this is me. This is my cash. I can't touch it. So I like the cash accounts personally. The next one is, will you be a trader or will you be an investor? It's a big difference, and we are going to definitely get into that. So trading versus investing. Trading is about buying and selling stocks for short-term profits, whether that be daily, weekly, monthly, or quarterly. They're not trying to stay in a stock too long. They're here and they're trying to get the maximum out of it. Trading is very lucrative. I both trade and invest. Trading focuses more on the share price and focuses on the direction that the stock is currently moving in so they can make money off of it. And there are more frequent transactions with trading than there is with investing. There's a lot more to go into it. And I noticed that trading does rely more heavily on the technical analysis side, which is seeing the resistance, the support, looking for patterns, stuff of the sort for the charts. Investing is more buying the stocks for long-term gains. So they take the long-term approach. They hold stocks for years, and investing is more used for retirement accounts. So they just put money in. They're not worried about what the stock is doing today, next week, next month. They're looking for 5 years, 10 years on the road. Do I see this stock continue to go up? So that's the difference really between trading and investing. Investing does take advantage more of dividend stocks, and it takes more advantage of interest and stock splits. So you're holding it so long that more things can happen to this stock, which is more ways for you to get money rather than just trading. You're just in and out. So really, I think historically proven, the buy and hold is one of the most proven methods for trading or investing. Very lucrative. You just buy a stock, you hold it for years. Because every correction, every crash that's happened, the market has corrected itself. It's gotten better. So the market might have dropped, but they go right back up. So the buy and hold method is very lucrative, one of the most common. And they mostly focus on fundamental analysis, investing over technical analysis. So they want to know exactly how big the company is and stuff of the sort, and what is it doing more rather than is it near a support line right now or is it near a resistance line? What is this pattern doing? Though they're holding it so long that these short-term patterns does not affect them. This will give you a little insight of like when you're actually in your platform for trading and you click on a ticker symbol or a stock, it'll show you a stock. And if you see the word bid on there, you should see the word bid, or you're not on the trading site more than likely. But bid is what buyers are willing to pay per share. And the ask is what the sellers are willing to sell that stock per share. So you get the bid and you have the ask, and you always see them going neck and neck with each other because that's what's fluctuating the stock price. People are saying we want to buy it for $10, but they're saying we want to sell it for $10.50. They're trying to buy it as low as they can. They're trying to sell it as high as they can. And normally it's going to be right around each other, but sometimes you do have a gap where they might be asking $10 to buy it, but the sale price might be $15. And if you buy enough shares, you can instantly buy 10 and then sell that for 15. But it doesn't happen all the time, but it does happen. So that could be a really quick thing for you. If that's what you like to do. Also on the little symbol, you'll see the 52-week average or 52-week range, which will be the lowest price it has been in the last 52 weeks versus the highest price it has been in the last 52 weeks, which is roughly around 1 year. And to let you know, it's been all the way from here, all the way to here. And there's usually a bar somewhere underneath that number, and it'll let you know exactly where it is in comparison to those prices. So if it's like, I'm gonna use $10 to $15 and it's around $13, you have a little line and it should have like a little bar around more closer to the 15 side, but just let you know we're this far away from the 52-week high. You'll see volume on this, and that's just the number of shares being traded of this stock. And the average volume is the average number of shares that are traded of this stock a day. Here we have Japanese candlesticks. So for the Japanese candlesticks, I know I have them up here on the slideshow for everybody to see in front of me. But I also drew them down because I know you here in the internet world, you can't see it. So I took the liberty just to draw them. And we're going to pretend that this one is green and this one is really red. So on the green one, you'll see that this is the body, that both have bodies of a candlestick. On the green one, it opens down low and it closes up top. That means this was a green day. It was a bullish day. This stock made money. It opened, let's say it opened at $1 and it closed at $1.20. Now you see these little lines above it. That means that this body at one point, it dropped that low. So it might have opened right here at $1 and it might have dropped to 50 cents. But it came back up and it went to $2. And then it dropped. And then it got down here to what I said, $1.25, $1.20, and it closed right there. And then the same thing for a red day. On a red day though, it'll open up high at the top, it'll close down low. So the green days, it'll open down low and close up top. Red days, it'll open up top and close down low. And you see they have wicks up here as well, because it opened right here. It might have dropped all the way down. So it could have opened at $1, dropped down at 50 cents, but then closed at 75 cents. But also in the same day, it could have went up to, $1.50. Something of the sort. And I like candlesticks because it shows you information. It shows you the price range. When you're looking at a line graph, it just tells you it's at this point. That's all. With this, it shows you it opened right here. It closed right here. It went this high, even though it didn't finish that high. It went this high today or this hour. Because you can show a candlestick on the hourly, the minute. You can do a daily chart, weekly chart, yearly, quarterly. So it all depends, but it lets you know when it opened, when it closed, the lowest it's been, the highest it's been. It shows more information on this chart than any other chart in my own personal perspective. So just using this chart alone is like a plus about looking at normal bar graphs and line graphs. In my own personal opinion, I'm not a financial advisor. If you know a financial advisor, ask them about it. You feel me? But until then, like and subscribe, follow my trading journey. Let's continue. Next slide, please. Boom. What is your risk level? Easy question. How risky do you want to be with your money? And the younger you are, the more riskier you can be. And I would say the younger you are, the more riskier you should be. Because if you're in your 20s and you're throwing like some cash into the stock market or real estate, whatever you're going into, and you mess up, you have time to recover. Your life isn't over. You have time. If you're in your 30s, you can be risky still. Now, I'm not going to say throw all your money in penny stocks or something like that, but you can still be risky. Now, if you are a little bit older and you feel like you don't have the time to recover from a huge financial loss, and you could, be a little less risky. Maybe do some dividend stocks, do something that's not going anywhere for a long time. And for financial security, we're gonna do a pyramid. You should see it in the video if I can edit it in. I'm really trying to. I promise y'all I will try. But in the pyramid, the bottom is financial security, and that's cash and cash equivalents, such as savings accounts. You know how much money you get back from savings accounts, a couple cents a year, unless you got some cash in that account. CDs, treasury CDs, treasury bills. I'm sorry, CDs accounts, life insurance. These are like a financial security blanket. So you're not gonna get huge returns from them, and your money might depreciate a little bit in the savings account. The rest of them you will get like a little small return, but you know your money is safe. Now, if you want to get a little bit more riskier than just having safe money, you can go to safety and income. And that's more of a low risk type of thing. And that'll be like bonds and treasury securities and stuff of that nature. It's a little risk to it, still kind of safe. Of course, those markets changes as well according to the economy, bond rates and treasury rates, I believe. And if you want to get a little bit more riskier than that, now you're going into growth. Now your money isn't just being safe and trying to gain little dollars here and there. Now you're trying to grow your money, and now you're becoming a little bit more risky. I wouldn't say this is high risk, but it's moderate risk, as the pyramid would say. And this is the blue chip stocks, the growth stocks, real estate market, mutual funds, royalty trusts. And the reason these are risky is or moderate risk is because you can get a return from it. And this return is going to be nice, but nobody knows what the market's going to do. So it's a risk. You could definitely study, do your research, pick wonderful stocks. But if the market is overall going down, your stocks are more than likely going to go down. No fault of your own, but it's just a risk you have to take putting your money into the stock market. So that's why that's a little bit risk. Like I said, there's definitely some safer things. Like they said, blue chip, you can invest in things that aren't going anywhere anytime soon. You know what I'm saying? And still make a little income on it. Walgreens, Walmart, McDonald's. Johnson & Johnson, Nike, Tesla. These are just examples of stocks that have been here for a little minute. Maybe not Tesla, but Tesla is a good growth stock. But these are other examples of stocks that's been here for a long time, and they're not going anywhere, I believe, no time soon. And these are also stuff that I'm sure everybody has heard of or used on their day-to-day basis. And for those who say, that's still, I want a higher reward than that. Well, high risk, high reward. Let's go to the top of the pyramid, to the speculative plays. Plays that are really high risk. You don't know what's going on with it per se so much, but if something goes right, this stock will boom. And for things like that, you get the penny stocks. Most of those companies aren't the best. Some of them do have genuinely good products. They do get brought on in a merger or bought out, or they make it somehow. A lot of them are crap companies, but there is money to be made off of them. Still, you still make money off of them. Options, stock options. For those who like to gamble, I think an option is like you're betting if the stock is going to go up or down. So that's the way to make money off of it. You can short a stock. So instead of buying a stock and saying that the stock is going to go higher, you can buy a stock at a high price and ride it down and still make money. So it's like the opposite of buying. You're going to short it. So you're betting the stock is going to go down in a sense. So the higher the risk, the higher the reward. And that's what you have to ask yourself. How risky do I want to be with my money? High risk, high reward. Low risk, low reward, but my money is safe. So these are just questions you want to ask yourself when you're getting started. Like I said, the next class, I will try to go in a little bit further in detail with some things I've learned along the way for trading. As far as some rules, I can give you a rule right now. Cut your losses quickly. So that way your losses are small. And when you have a big winner, that winner is big. So you might have 4 losses for like $50. It's $200, but you might have a big winner for $1,000. So overall, you're at $800 on 5 trades. You lost 4 and you hit 1 big. It's kind of like a YouTube video. It only takes 1 video to get you viral. I mean, take the right patience and the right stuff. It only take 1 stock to make you rich. A lot of people have been investing in Tesla heavily since it was around $7. Tesla is around $600 now. And that's after the stock split. So imagine when it was at 3,000 something, and then it came down. So that's that. Like and subscribe. Shout out to everybody. Thank you for joining me.
Are you trading yet? It's time to get in the game.